Alrighty, folks, we need to know what's going on with the big money funds on Wall Street. This week has been basically negative, negative, negative. We've got the first negative print for GDP, down negative 3%. We had a horrible unemployment report this Thursday with a spike to 241 from the baseline of 220. All the jobs numbers this week have been weak and very disappointing. We've got a 10-year note that's down at 4.2. It was just over 4.5. So, are mortgage rates getting better? Are we seeing Wall Street funds get more aggressive? Or do we have a worst case scenario where Wall Street is getting nervous about the economy and actually expanding their spreads? Never forget, folks, we went as high as 310 basis points during the peak of the craziness and the pandemic. I think we're currently at about 2.5. So it can get worse, and we got to find out. Is it getting worse? We're going to talk with Dustin from Convoy Home Loans. Dustin, what's going on, man? You are in this game each and every day. You have a pipeline of Wall Street money funds. I want to know, are they getting aggressive and looking to buy business? Or are they getting nervous and expanding the spread? What's going on?
I would say I would say that it would be there's more than just one Wall Street hedge fund, obviously, right? I'd say it's kind of split down the middle because what we're seeing on both sides of the spectrum, if you will, is half the funds are keeping and making sure that the spreads right now are bigger than what they were 2 months ago, 3 months ago, 4 months ago. Because if you look at the current rate sheets right now for the same particular fund that was back in, let's say, September, October, when the 5 and 10 year were, same kind of 3.6, 3.7, low fours, breaking four almost, kind of what we're at today, right? The rate was 3/8 of a percentage point lower in September and October than it was today. So to give the idea to the consumer, the audience, like, what does that mean? The spread got bigger for them, and that's all based off uncertainty, right?
Absolutely.
The other side of the coin is that I think this was last week when I spoke about this, but a lot of the hedge funds are moving to the SOFR, right?
Correct.
Not the
We
the
did talk about that.
treasuries,
Yeah.
and they're using that so that they can make the rate that's being offered, right, to consumers, to investors for DSCR loans, etc., the same as what it would be if the spreads were the same as they were in September or October using the treasury compared to
Got it.
today.
Yeah.
So
So
it's
let me
yeah.
talk. I want to talk about these Wall Street money funds. And again, I may have my history wrong, so please correct me if I'm wrong. But I believe the Wall Street money funds, whatever you want to call that category of lenders for DSCR loans, if we are going to go through a recession, this is going to be the first really recession for this new investing type, right? This is non-bank lending. And historically speaking, we might see a lot of pain. There might be a lot of DSCR lenders that were maybe over indexed to Airbnb, for example. Might have been short-term rental, funds. We might have seen people do, maybe aggressive DSCR lending at 80 or 85% of value. And if we go into recession and these, owners can't pay, this these spreads could widen. These spreads could quote unquote blow out, if you will. Is this the first recession that this type of money is going to go through?
I mean, this type of money, yeah, I'd say so in this particular product and collateral, yes. Ultimately, you brought up being in terms of overexposed, I would say, from the hedge fund side to the Airbnb and the 80 to 85% purchase, cash out, et cetera. That was pretty darn common 2, 3, 4
Yeah.
years ago. Even when we started on this channel, what I'm, you know, seeing sitting at my desk, John and my desk, we get, of course, everybody that's ever done a loan through, Convoy and any of our hedge funds, right? We'll see and we'll get notified when these DSCR loans and the operators are not making their payments on time for the first 6 months or even the first 12 months. We'll call it's a scary word if you're in the industry, but it's an early payment default, which hedge funds have reps and warranties with us, meaning if a client doesn't make a loan payment or is more than 30 days late in that first 6 months, it's on their radar, and that loan all of a sudden is going to be very, very hard to be sold to that hedge fund, meaning Convoy would need to step in, repurchase, resell, make the payments for the client, and probably sell it for 90, 95, if you're lucky, cents on the dollar. It might go as low as 80 or 70 cents. And the reason I bring that up is because we're seeing way more of it right now. As bad as that
What is
sounds,
that
we're
called
seeing
again?
way more of
That's
it.
what is that word or term?
Early,
What is it? One more time?
it's an early payment default. So part of pretty much every single DSCR lender that anybody's going to work with here is going to have a rep and warranty type contract with the hedge fund that they sell these notes to. Okay. And
Mhm.
part of the requirements that the hedge funds put on is, look, if your borrower is more than 30 days late in the first 6 months, that's an immediate red flag. Like this is not a loan we want to be a part of. We don't want to buy this.
Right.
We're not going to buy it from you. That $300,000 DSCR you thought we were going to buy from you, we're not. So now you
Mm.
can go to the secondary markets, right? The guys that are kind of the hard money guys of the secondary markets, and see how much you can get. And you might get, like I said, 90 cents on the dollar. And guess what? That's a very heavy hit for, one loan. But if you're a big company, like for example, Sprout 2 years ago, that's what happened to them, right? They couldn't get everything. They lost 10, 15 cents on $1 billion, and that's how you get rid
Right.
of a company really quick.
Yeah, this is going to be something we're going to have to watch. So I'm going to say something you could disagree or not, or put color around it. Is it fair to say, right now, comparing to last year and the year before, that early payment defaults are exploding? Are you seeing an increase of double digits percentage, maybe triple digits because it's a small number? What's going on? Are they exploding higher or not yet?
I wouldn't. I mean, maybe this is exploding. Depends what lens you're looking through. So I'm gonna go a little farther. Maybe 2 years ago, when it was a little bit calmer waters, right?
Sure.
Um, I, let's say we Convoy does 200, 250 average like closings
Sure.
a month, right?
Sure.
Just for DSCR specifically, we're talking, right?
Yeah. Not
Uh,
conventional, none of that other stuff. You do a
Not
lot more than
conventional,
that. We're
not
just talking
bridge,
DS.
just
Yeah.
DSCR, probably two to two
Right.
fifty a month. Okay.
Okay.
Uh 2 years ago we'd see like two or three notices, right? And it may have been like a servicing transfer or something where it's like early payment default notice, but one may go over. Now we're probably seeing 10 to 15 a month.
Yeah. So again, if you want to talk percentages, that is exploding, right? You go
Yeah.
from 2 to 15, that's 700%.
Yeah.
If you look at just numerically, it's maybe not scary, but again, if you're talking about a trend and the trend is clearly one way, this again, I think where I really wanted to go early in this conversation is this part of the market is going to get tested over the next 12 to 18 months. And what I hear you telling me is Michael, you're a little late to this party. The test has been going on at least a couple of months, and the returns aren't totally counted yet, but yeah, it's getting worse.
And what's really sad and scary is a lot of, not all of them, but I don't know what the numbers are on this, but when our most recent one, and then we dug a little bit further for another month for one of his partners, getting early payment default, and this is a discussion being held at the roundtable, on a cash out loan should never be the case, right? It should never be the case. Getting 400K, 500, whatever it might be, right? And the payment might be 5 or 6K 2 months later, and you're not making that payment. It's going to
Yeah.
start. I don't think it will anytime soon, but just kind of like a fix and flip loan where they're only going to pay the bill once the proof of the work is being done, or pay the contractor directly. DSCR cash out might be limited in terms of, okay, what are you using for, where is it going to, let's look back in 3 6 months and see that it was done. If not, we can do something else. But that's what uh I'm seeing way too much of, is DSCR cash out loans that we originated 2 months ago, and they can't make the payment. So
Yeah,
something.
that I mean, just think about that. So what we're basically talking about, folks, is somebody has an asset, they have a big equity position, and again, Convoy does big loans. So you're talking about $1 million house or whatever it is. You go in and extract 200 grand. My example, not yours, and suddenly they can't make the payment. Let's say the payment's 6 7 grand. That's a bad look. You just got a check for $200,000 and you can't pay 7 grand. What does
Yeah.
that mean? And again, cash out refis are interesting because I think the most aggressive I see is 80%. I suspect most of them are 75%. So if you're taking that amount of cash out and leaving that amount of equity and you can't make the payment, something big is breaking in that borrower.
Yeah, 100%. And I don't like to see it. It's not a fun conversation that, we have to have, John and I, with why we can't get a hold of the borrower now, or why did they take the cash and not do something with it, wisely. No offense, right?
Yeah,
We're
we
never
don't know.
supposed to, uh, you know, tell anybody that you can't take the
Yeah.
200K and go to Vegas, right? Can't take the 200K and spend it on hospital. Like, you can do whatever you want with it. It's your property.
Yep.
But if you're taking
Yep.
a loan where you're not providing any sort of personal income to qualify and we're just using the rents, we know you're getting the rent payment. We know that, it covers the mortgage. So
Yeah.
what's going on here?
Yeah, it's going to be really interesting to watch these early payment defaults because I think they're going to tell us a story. And I think the story is going to be what part of the DSCR market broke. Because I think the DSCR market, Wall Street came in and they tried to be everything to every investor. And I think some of those are going to come back and bite you, right? Maybe it's the Airbnb in Palm Springs or Airbnb at Lake Havasu or any of these other very concentrated markets. Maybe it will be, maybe it'll be the DSCR cash out refis on
I'll tell you what it
$1 million.
is.
All right, let's go.
Not
What
for,
is it?
it's the last 3-4 years, and there's still a lot of them out there. I'm not calling any of them out right now, but the no ratio DSCR loans are the stupidest loans in this industry right now. And I'm in the industry and I do a lot of DSCR, but no ratio. Now, a lot of times that word is used interchangeably with meaning like, okay, it's below 1 on the debt coverage, but it's at least above 0.75. There's still a lot of DSCR lenders out there that will literally go down to 0.3. You could have a
Yeah.
$10,000 mortgage payment and the rent you're collecting is 3K, fine. Instead of getting a 7%, here's an 8.5% because you're not cash flowing. And what does that do? It's kind of counterintuitive. It's like you can't
We call
support the
those
mortgage
alligators
payment.
here. That's what we call
It's
those. Those
it's
monster alligators.
you're asking. I mean, you're just you're.
I don't know what you do in that
I don't.
situation. You're begging for mercy or something.
Yeah, it's logically, and I think it's irresponsible. I don't think I'll get in trouble for saying that because nobody's gonna. None of my hedge
Yeah.
fund partners are watching this, unfortunately, or fortunately. But
Yeah.
it's
Well, again,
irresponsible
yeah.
lending.
And again, that's what happened in the Great Recession. This is
Yeah.
again, a lot of the pain will likely come to these no ratio loans. So let's kind of close on a positive note. Again, I think
Yeah.
2025 is going to be the year of the investor. I think we are clearly seeing demand fall from home buyers. We're seeing supply explode across the country. I know Convoy does a lot of stuff with real estate investors. Are your clients writing disrespectful offers and getting deals done today?
Yeah. Ending it on a high note, we're busier than ever. As crazy as that might sound, we're
That's
as
awesome.
busy as we've ever been. And why? Because our community and our clientele, our investors, and everybody knows this. I'm not gonna,
Exactly.
tell anybody anything new here, but you want to see those articles that say housing crash. You want to see all of the clickbait that you get on there because that should just be like Christmas morning every single morning.
Yes. Yes. Folks, at the end of the day, you want environments with less competition, more inventory, more motivated sellers. You should not care about the cost of capital as long as everybody pays the same. Just write offers that cash flow day one. No alligators. Get 30-year fixed rate debt, please. I see more and more people talking about ARMs. No, no, no in my world. Dustin, if somebody wanted to reach out and get something started with Convoy, what are we doing?
Just go to convoyhomeloans.com. Make sure that you click the drop down that says where you came from and mention you came from ORAT.
Yep, folks, convoyhomeloans.com. There's a little blue button that says start or file or whatever it says. In there, there's a drop down. Say you came from ORAT. That would be great. You got to do that because you want this guy to help you. If you don't say you came from ORAT, you're not getting this guy. He's a big wig. You want to work with the big wigs. Take care. Thanks, buddy.
Thanks, Mike.